Hello and welcome to this economics content training video produced by the Georgia Department of Education. In this video, we will go over Macroeconomics Standard SSEMA2, elements C, D, and E that relate to monetary policy. The Federal Reserve System was created in 1913 for the purpose of centrally controlling the money supply of the United States. This was largely in response to a series of financial panics and bank runs in the late 1800s and early 1900s. The Federal Reserve System, called the Fed for short, serves three basic purposes. 1. Maximize employment. 2. Stabilize prices. And 3. Moderate long-term interest rates. The first two are collectively known as the Fed's dual mandate, as described in element E of this standard. Since 1913, however, the Fed's roles have substantially increased and now include a wide variety of functions in addition to the three original purposes. These new roles include banking supervision and regulation, providing financial services, and maintaining the stability of the financial system. For the purposes of this video, however, we will focus only on the Fed's involvement with the nation's money supply. When the Federal Reserve Bank is making decisions or taking actions that have an impact on the nation's money supply and credit, the bank is conducting what is known as monetary policy. Monetary policy exists to control the amount of money in circulation. Why would the Fed want to do this? Well, traditionally, if too much money is in circulation, banks have a tendency to want to lend that money, since making loans is a major way that banks make money in the first place. And since there is so much money in circulation, banks are willing to loan it at pretty cheap interest rates. This makes borrowing money easier, which can lead to more consumption of big-ticket items like cars, houses, appliances, etc. This is great for GDP, but too much money in the economy can also lead to rapid inflation, since everyone is buying goods and services at a faster rate. Too little money in the economy means that banks don't have as much to lend, thus they must charge more for the loans they do make, and this makes those same big-ticket items more difficult to purchase and slows the economy down. For more about how this works, go to YouTube and search for a video called "The Fed Explains Monetary Policy." It is produced by the Atlanta Federal Reserve Bank, and the picture you are looking for looks like this. The point we're going to make in this video is how the Fed controls the money supply. The Federal Reserve has a variety of tools at its disposal to accomplish the objectives of maximizing employment and stabilizing prices. The Georgia Standards of Excellence asks students to define 4 of these tools and describe how the Fed uses the tools to promote its dual mandate. The first tool listed in the standards is the reserve requirement. The reserve requirement is the amount of money the Federal Reserve tells banks they must keep on hand and not lend. When a person deposits money in a bank, the bank uses some of that money to make loans to other customers. In order to prevent banks from lending too much, the Fed requires banks keep some of their deposits on reserve, hence the name reserve requirement. Well, how does this work to help the Fed achieve their dual mandate? In theory, it works like this. A very low reserve requirement means that banks have the ability to lend most of the deposits that come into the bank. This would be good for consumers looking for loans and should increase economic growth. A higher reserve requirement, on the other hand, restricts the banks from making so many loans and should slow economic growth. In reality, the Fed has placed the reserve requirement roughly around 10% and actually does not change it all that much. It is the least used tool of the Fed. The second tool listed in the standards is the discount rate. The discount rate is the interest rate banks get charged if they borrow money from the Fed. Now, before explaining anything else, it is important for students to understand that on any given day, banks are borrowing extremely large sums of money in order to keep their reserve requirements in check. Our monetary system is very fluid, with people constantly making purchases, taking loans, repaying loans, defaulting on loans, depositing money, taking money out of the country, bringing money into the country, etc. As you can imagine, this makes tracking all of this money quite difficult. The problem for banks, therefore, is keeping their reserve requirements in balance, and this can be challenging from time to time as banks do not have enough in their required reserves. In this case, they will need to borrow money. Well, from whom do banks borrow? Well, other banks, of course, but they can also borrow from the Fed at the discount rate. Intuitively, this tool is pretty easy to follow. If the Federal Reserve is charging a very high interest rate, then banks see that as a signal that they too should be charging higher interest rates, which will slow down the economy. On the other hand, if the Fed is loaning money at very cheap rates, this is a signal from the Fed that other banks should be doing the same thing, and this can increase economic growth as interest rates fall. One final point on this topic is that the Fed actually does not wish for banks to borrow money from them at all. The Fed prefers banks to borrow from each other and use the Fed as a last resort. In fact, the Fed is often called the lender of last resort. Because of this, the so-called discount rate is usually actually more expensive than bank-to-bank lending. The third tool from the standards is open market operations. Make sure the students understand that in addition to money, banks also hold a wide variety of assets, including stocks, their own loans that they've made, property, and one other important asset, Treasury Bonds. Federal Treasury Bonds are investments that guarantee a certain return over a period of time. They are issued when someone lends the federal government money. The bonds are a promise to repay. Banks like holding these because customers sometimes want to buy them, and they provided banks with a little bit of income. The Federal Reserve also has billions of dollars of bonds, and the Fed can use these bonds to help them achieve their dual mandate. How so? If the Fed wishes to get more money into the economy, they go into the bond market and announce that they are willing to buy bonds from the banks. The banks send ownership of the bonds to the Fed, and the Fed sends money to the banks, which the banks could now lend. In reverse, the Fed goes to the bond market and announces it is selling bonds. In this case, more bonds go to banks, and banks have less money to lend. To help students remember this, repeat this phrase over and over as you teach this topic. Buy bigger, sell smaller. Buy bigger, sell smaller. When the Fed buys bonds, the money supply gets bigger. When the Fed sells bonds, the money supply gets smaller. Buy bigger, sell smaller. Buying bonds is expansionary, and selling bonds is contractionary to the overall economy. Finally, the Georgia Standards of Excellence also exposes students to a relatively new tool of the Fed, interest on reserves. The Federal Reserve System was granted this power in 2008 as part of the Emergency Economic Stabilization Act. The tool gives the Fed the ability to pay banks interest on the reserves that they keep at the Fed. If you've been following along so far, you'll remember that banks are required to keep a certain percentage of deposits at the Fed anyway. In truth, banks actually hold more than their required reserves with the Fed. And with the Fed paying interest on these reserves, banks have an incentive to do so. How does this help the Fed, though? If the Fed is paying a high rate of interest on reserves, then banks will have an incentive to store excess reserves and not lend them out. With a low rate of interest, banks are likely to see loans as a better option to make money and be less likely to keep excess reserves. There's another feature here as well that's actually very useful for the Fed. Because the Fed is paying a specific interest rate, that sends a signal to banks as what they should be charging for their own loans. For example, say a bank has some excess reserves and is trying to decide what to do with them. Let's say the Fed is paying 0.5% interest on reserves. If that is the case, there is no reason for the bank to make any loan for less than 0.5% because they can earn that much from the Fed. If the Fed were to raise this to 0.75%, well, that would be even more incentive for the bank to store reserves or raise their own rates, both of which are contractionary in nature. For more on this fairly complicated topic, go to YouTube and search for a video called How Interest Rates Are Set, the Fed's New Tools Explained by the Wall Street Journal. Its screen capture should look like this. One note about the Wall Street Journal video. The end of the video goes into something called the reverse repo program, which is not in the standards. So use your discretion in whether or not you want to show it to your students, but it's beneficial for teachers to see. To summarize, here is a chart that shows each of the 4 tools and how they affect economic growth. The Federal Reserve is a critical part of the U.S. economy, and through the use of these tools, the amount consumers pay in interest on everything from their house to their car to their small business loan is affected. These may seem like high-level concepts at first, but they have a very real and practical implication for everyone participating in the U.S. economy, especially people who borrow money. For more information on the Federal Reserve and monetary policy, please visit federalreserveeducation.org.